Singhania now joins us. Sunil, good morning. Thank you for joining us. Sunil, why is there such a big disconnect between markets and the economy? Companies are struggling to give a guidance. Analysts are queuing up to come out with downgrades for the companies they track. Economists are comparing this as the worst economic patch in last 100 years. And both local markets and global markets are celebrating as if a new economy stroke earnings bull market has started. Who will get it right? Who will have the last laugh eventually? The investors or economists and basic analysts who are raising concerns?
The market has a life and move of its own. If it would have been so simple to gauge the market movement based on what was happening on the economy front or only one factor, then we don't need so many books which are behind my back to understand the markets. So I think market is a combination of a lot of factors. Obviously, economy is a big factor to it, but there is never a direct correlation between the economy and the market on a day-to-day basis. In fact, it's said that markets are always either lagging the economy by a year or ahead of the economy by a year, and it's only after 3-4 quarters that you realize that they will finally, converge to some extent. So I think what we are seeing right now, one is obviously there was a huge fall, largely because of the scare, one in a lifetime kind of a scare where no one knew what was going to happen. Now, as things are getting a little bit more and more, saner in the sense that people have accepted that this is here to stay, but it's not like a crazily life-threatening scenario. Yes, you have to be careful, but people are going back to work. And I think at least in some countries, like even the US, we have seen a good recovery. May retail numbers, for example, in US were almost 14% higher. In China, across sectors, we are seeing some move on the upside. Even in Europe, we are seeing that. And even in India, we are behind the world in terms of opening up and recovery. But a few sectors which have opened up, rural focus sectors, even some lead sectors like cement, long steel, there is an optimism. And I think the worst thing is that we had, written off everything. Even on the financials, we had said that this is going to be a crazy year, and maybe it's not going to be as bad. So, I heard you saying, just before you made me join, I think this is a scenario where, words can become bad or bad can become better. And I think that is what the market is sort of discounting.
Sunil, since you refer to books which are behind you, some of the authors who've written these books are Ray Dalio, Howard Marks, Stanley Druckenmiller, autobiographers of Warren Buffett, Sam Zeel. Now the common thread I'm trying to say, Sunil, here is that from Howard Marks to Sam Zeel, from Warren Buffett to Charlie Munger, everyone is quite skeptical about what is happening in the equity markets. So if the authors and the masters of the books are to be believed, then looks like we are headed for tough times.
Elon Musk also there. So, it's a mixture. It's not only this. So, obviously the names you mentioned are some of the greatest names that you've ever seen. And I'm not saying that we should just throw all the caution to the air. In fact, we are also quite cautious. But at the same time, we have to be open about what might happen. So yes, there is a probability that, the world is going to face a lot of stress, which we are already facing. But there's also a probability that over the next 2-3 months, we might have this scare reduced quite significantly from here on. It's already come down a lot, but even from here on, it might reduce. And then, you take a call that, 3 to 6 months of P&L is gone, but balance sheet of these companies are intact. And come 22, you will have a favorable base effect. You have this huge liquidity. You have very, very low interest cost. And suddenly profitability of FY22 can be back to what people were expecting, pre-COVID levels. Yes, FY21 is going to be stressful, but FY22 might come back on track. So it's basically a game of, probability in the sense that what can happen and what cannot happen. It's still early days. So, you have to be very cautious. You have to be sure about what kind of companies you're getting in. And I would completely agree with you that all these chiller companies and penny stocks are something which one should avoid. There is a huge move there. People are just saying that this 100 rupee stock is now at 5. Let us buy that. I think it will give you a near-term, thrill, but ultimately, it's like a roller coaster. It ultimately has to go down.
Sunil, you've been a big proponent of buy value, which is buy stocks when they are cheap, where P multiples are low, when stocks or companies are available below the intrinsic value. But off late, and when I say off late, for last couple of years, that strategy has not worked. Are you somewhere getting worried about why value investing is not working, and why and how should markets really judge value investing at a time when interest rates are low and inflation will not come back in a hurry? Because value investing typically works, Sunil, when there is a cycle when interest rates go higher and when interest rates kick in. That cycle is not there. So will the true blue value investing work now?
A little bit tilted towards value, but we are not only value. In fact, since the start, I have branded myself as being an opportunistic investor. So India provides value, India provides growth. The only disconnect which I have is that you cannot buy a stock just because it's a growth stock at any valuation. So you have to buy even a growth stock at a value which discounts the future profitability. And in fact, unlike what you're saying, it's working. So we had a gold finance company which was a value sort of a stock with decent growth, and you had the fastest growing NBFC where everyone was chasing at 7-8 times book. And on a 1 year basis, the outperformance is 125%. So I don't agree with you that it's not working. Where I would say is that just don't buy anything which is value just because it is 3p, 4p or 5p on the face of it. It's also about whether this earnings are going to sustain, and you need a little bit of growth. And that's why, our definition of value is 15, 15, 15. We want a below 15p stock, but we also look at 15% growth possibility. So I would say that growth at reasonable value is what you have to focus on. And I think market is slowly accepting that. The consensus trade was buy anything which is quality at whatever price. And now we are seeing, stocks are floundering. There is a continuous, I would say, analyst downgrading one after the other. The best known consumer names are being downgraded. Yes, the price impact has not been all that great so far, but I think it's a matter of time before valuation will take into account and the price will take into account the valuations and the future growth probability.
Sunil, is there merit in aligning more with global businesses than local businesses? Because there is every reason to believe that in the recovery phase, global markets will recover faster and ahead of what Indian markets would do. I'm not getting into reasons, but for an investor, let's say, who has choice to, let's say, invest in global dominated companies versus local dominated companies, should the choice be more tilted towards global rather than local?
You're absolutely right, Nikunj. At least for the next 6 months, I would agree with you. US economy looks like being the strongest, and they have this unlimited ability of printing currency. The savings rate there have shot up to 30-35% because every family has got checks in their bank account. People have not spent last 2 months because they were indoors, and now when the economy opens up, you're going to see a huge surge in spend, and I would not be hesitant to say that we might suddenly have US economy even growing at upwards of 3.5% in the second half of the current calendar year. And in that respect, companies which are focused towards the US or the global markets would in the near term be a little bit more secure. So, whether it is export-oriented pharma, whether even it is even IT, despite being an election year in US and all this rhetorics about each one might be there, but still, IT might bounce back faster. And even some of the, we are seeing already engineering exports in May doing very well for India. So these export-oriented companies might do well. But, we should not forget the fact that now this Atmanirbhar and Make in India, and suddenly with this Ladakh issue between India and China, and the government talking about more and more, protection against Chinese imports, you might have some of the local facing companies get a breather in the sense of extra protection. and we have to be open to it.
Where does PSU investing fit in your scheme of things? I mean, let's keep oil companies aside. They have policy challenges, but a BEL, BEML, even BHEL, they're cheap, they have dividend yield, and there is no solvency risk there.
Oh, so see, my experience with PSU investing in the initial phase of my fund management career was superb. But I think in the last 8-10 years, we have seen the ROEs of these companies go down dramatically. From a net cash company, most of these companies have become net debt company. There has been cross holdings which have been encouraged by the government, obviously, to fulfill their disinvestment targets. And therefore, I am a little bit skeptical in a lot of these companies. So these companies are asset rich for sure. I don't agree with you that there is no solvency risk. We have seen companies like MTNL and BSNL not pay to their vendors for years and years and years. So on the face of it, you can say that it doesn't have solvency risk, but from an equity investor, there is a risk. However, some of these companies have become too cheap, and maybe there is a trade there. But I would be a little bit skeptical given my past experience.
Okay, there's one stock which will definitely bring smile on your face, and I just want to establish this for our viewers because this is one stock Sunil had identified years ago, even though when he was not running his own personal company, he was with a different asset management company, and that's Muthoot Finance for you. Here's a company, Sunil, which comes out. No one thought that the gold finance business is a sexy business, but they've surprised both on the upside, also in terms of delivery and also in terms of growth. What is so special about some of these gold finance companies that you like them and they continue to deliver?
So one is, we are not in the business of investing in sexy businesses. We are in the business of investing in businesses which make you money. And I think this is one segment which is the most secure. In fact, the gold finance business is more secure than even the mortgage finance business because, in case of default, it takes you like 5 minutes to liquidate the assets. Even a house would take you a year and multiple lawsuits before you are able to liquidate. So I think it is very, very secure. There has been zero net default for this company. There is obviously provisioning which keeps on happening based on RBI norms of delay in payment, but there has been never defaults. The third thing is, it's a business which is very difficult. The average ticket size is 50,000 rupees. Now, for a book of 40,000 crores, technically, you imagine you have 1 crore borrowers. 1 crore borrowers. 4,500 branches, almost 30,000 employees. So it's very, very small ticket and very difficult business. And the most important thing is, a lot of people have tried coming into it, but they get tired because it takes time to build this business, as it is very small ticket. So to grow your business to even 500, 700 crores means, you need lakhs and lakhs of customers, and the initial cost can be very high. And I think this is a company which has 75% promoter holding, zero pledge, very, very low-key guys. When you meet them, they're down to earth, focus only on their business. And obviously, it's worked. So I would say that this was a business which was growing at upwards of 15%, trading at like 6-7 P, less than one-time book, whereas all the other so-called sexy NBFCs were growing a little bit faster maybe, but they were taking higher risk in terms of unsecured lending and so on and so forth, and were trading at anywhere between 4 to 8 times book. So I think it's worked. So I think what works in hindsight, you can take the accolades. But maybe, in this kind of an environment, if some company stands out where they declare record profits when everyone is under stress, I think that is what the market has realized.
If markets are voting for economic recovery, Sunil, why are banks getting a stepmotherly treatment? Because for economies to do well, banks have to do well. Now, we may argue that it may be private or it may be PSU, or it may only be Bajaj Finance and other NBFCs, but credit has to grow. And if credit has to grow, is it a good time to buy banks after the recent leg of underperformance?
So, Nikunj, we are in a phase where fear and scare is at the peak. Even people who have money in the bank, money with them, have have just parked it in a saving account. They are so scared they don't even want to invest in some fixed income security, leave alone equity. And I think the same is the case with banks. I think they are flush with liquidity. But obviously, there is so much uncertainty, and we started the show with that. We don't know which companies are going to survive, which companies are not going to survive, which businesses are going to come back, or which business will just, vanish. And I think in all this uncertainty, and given their past history of massive, non-performing loans, there is a fear which is at the peak as far as banks are concerned, and they are right now hesitant to lend. But having said that, you imagine the liquidity. Housing loans, if you are in a floating rate, housing loans have come below 6%. 3-year bond rates for good companies are available at like 4.5%. So, banks have so much liquidity. It's only a matter of time when confidence returns. I think credit will grow. But till the confidence doesn't return, it's very logical. They are lenders, and to make 3%, you are risking 100 rupees of your loans. So it is logical that they will be a little bit cautious. But let the confidence return, and we will see some uptick in credit definitely.
How do you propose one should bet on the so-called digital and telecom opportunity? Because right now Bharti seems to be the only game in the town. Is it logical only to stay with the market leader in the telecom space, or as a mid-cap investor, you are ready to go outside the comfort of Bharti?
Actually, there are unfortunately, unlike the notion that India is a closed economy, India is one of the most open economies. So most of the digital opportunities in India have been captured by the multinational companies, whether you take the Amazons of the world, or the Googles of the world, or the Facebooks of the world. We have a few options left, which are basically, enablers to this. So, you have 3 telecom companies which are listed. Obviously, the smallest in terms of market cap has its own issues because of the huge, AGR dues, which is overhanging, and the huge debt. And that lives with 2 plays. And both the other plays have done well. And I think in our fund, we have both the plays. So I think that is the only way of playing the sort of digital opportunity in India. But, Nikunj, this is going to be a huge opportunity. If you remember, post-demon, everyone started using credit cards. It became a big push towards, sort of hastening the process towards digital currency, whether it was, the UPIs of the world and the Paytms of the world, or even the credit card and the debit cards of the world. I think this lockdown, and I can see my own habit and the people, my neighbors and the friends in the building. I think the move towards everything online is huge. So whether it is buying groceries or some other material, or even consuming services, whether it is doctors, health, spa, this physiotherapy, exercise. The move towards the digital economy is like never before. And I think there have been exciting reports which have come up, which says that India's move towards digital was very slow. And I think this lockdown has led that move to really hasten. We are still miles behind China and US in terms of embracing the digital world. And, there is definitely going to be huge opportunity. But as I said, unfortunately, not too many listed places.
So how do you see consumers moving now?
So again, I think this has been a very different kind of experience. All of us have been at home for varied periods of 2 to 3 months. Our habits have changed. I think there has been definitely some job losses, salary cuts for the mid to higher level employees. And there will be 2 things which will come into play. One is a reduction in your disposable income, and that would mean that your discretionary spend would reduce. And therefore, I would be a little bit wary of anything to do with luxury retailing, or even something which is like discretionary. The second is a scare. I think the scare is going to be there for some time, and therefore the propensity of people to consume services which entail being in crowd, whether it is flying or going for a holiday, or going to a crowded mall, or even visiting a theater, is going to take some time. And I think those consumptions will reduce. But at the same time, human beings are human beings. We would want to spend. So maybe this money which would have gone into some of this would get consumed in some other way. And I think therefore maybe the down trading or the value consumption goods might see an uptick. Maybe some extent two-wheelers I would say would see an uptick. And we should also not forget that our habits have also changed while being at home. So things which we were consuming outside, we might start consuming inside the house. So I think packaged foods, movies on the OTT platforms, they will all I would say just see a massive growth. One last thing, there are still restrictions in a lot of societies, complexes, houses where they want to minimize people coming into their houses. And I think that is why, at least for the next 6 months, building materials, tiles, paints, sanitary ware, might see a little bit of demand sort of challenges.
So, Sunil, if someone is ready to, let's say, look 3-4 quarters out, and if 3-4 quarters out we work with an assumption that things will normalize, something would be discovered on vaccine, but markets are not ready to believe that, because on the COVID front there is fear of a second wave. There is fear that in India things may not get contained. As investors we tend to look at only Delhi, Mumbai numbers as a representation because we live in Mumbai and Delhi is an important city. So what I'm trying to understand from you, Sunil, is that where do you think markets currently are disproportionately pushing companies or stocks down which actually will not survive, which will emerge as a better and a stronger business or a stronger entity?
So one thing is, at these levels, I would not say the markets are exorbitantly expensive, but I would also not say that they are cheap. I think on an index level, we are already discounting the likely FY22 earnings by almost 17, 18 times. So they are not cheap, definitely, and not very expensive given the fact that interest rates are falling. So, the PE multiples globally will go up, and even in India, G-Sec yields from 7.5% have fallen to 5.8. So the PE multiples are going to rise a little bit. At the same time, what has happened in the market, and that is the beauty about Indian markets. Now we are very diversified. So the initial strength in the market came from the so-called quality and the consumption name. It lent stability, and then pharma took over in the sense that they did very, very well. And though it's a small portion of the Nifty, it did support. I would say the laggards in the markets have been the financials, which have still seen 30-40% lower from their highs. And I would say for the Nifty to move up, meaningfully from here, the financials have to move up. Without the financials moving up, I don't see the other sectors being meaningful enough to move the market up here. And here I would say that a lot has been said that everyone loves to say that we are now reducing financials and logging into pharma and all. I would say that financials is not a bad play. In fact, in one of our smaller funds where we invest in mid and small caps, we had very low weightage to financials, luckily, before the COVID. And there, we have been buying a few housing finance companies. We have also bought a sort of a vehicle finance company. And I think the logic is very clear. Fresh commercial vehicles might not be sold in a hurry. But the vehicles which have already been lent to, I think there is an increasing improvement in the capacity utilization. So we were speaking to a logistics company yesterday. So from a 20% truck utilization in April, it went up to almost 50% in May. And they're already trending up to 65% in the first half of June. And their estimate is that by July, the existing trucks would be 80-85% operational. And the rates have also moved up because there is obviously a shortage of drivers, trucks, and so on and so forth. So this whole concern about massive write-offs, and which some of these companies have already taken in March, might spring a surprise. And at 6-7 times PE at almost 2 to 3 times pre-provision operating profit. And there is a lot of value there. So I think we are in that camp where, yes, you have to be a little bit cautious, but also look at companies where we are discounting maybe 90% of the pain. So, the risk reward then is in our favor. So unless there is a second wave of COVID, as you said, it's a possibility. I would say the probability is maybe 5%. I don't see it to be a very big probability. But, if things improve, then these are the companies which would see massive re-rating back again.
So Sunil, closing comments. You take a lot of pride because you've identified a lot of stocks in bear markets which have turned out to be big compounders. Are the table settings right that 3 years from now, 4 years from now, we could get into a massive bull run in some of the small and the mid-cap stocks, or we are not there yet?
So Nikunj, it's a cycle. And it's only in hindsight you realize that, this stock or these set of stocks were available so cheap. We wish if we knew that what are going to be the stocks which are going to be 10 baggers in the next 10 years. But, one thing which we have to remember is that in this age of digitization, the concept of, buying and forgetting for 20 years is now going to be a little tough, because we are in a world where our consumption patterns are changing and even the way we consume is changing. So, we have to be a little bit more, I would say, up there in terms of reassessing the portfolio regularly. The other thing is we should not forget that digitization might come, but there would be few products which we would need to produce in the same primitive manner, and these would be the boring businesses, maybe cement, steel, metals, paper, and so on and so forth, plastics, and so on and so forth. And I think in some of the cases, stocks have gone to like 10, 20, 30% of their replacement value. They're trading far below book value. And mind you, these are companies which have over the last 10 years demonstrated a CAGR growth in double digits. Yes, because of their nature, in some year they will have 30% growth, in some year they might even degrow. But over a period of 5-10 years, they have demonstrated a growth of, in double digits. And I would say that those are the businesses where if you have patience, where you are not answerable to the media and to your investors about what has happened in the next 1 month or 3 months or 6 months. These are the businesses which will do a lot of good. At the same time, the world is evolving, and we have seen how, because of digitization, it's easy or much easier to grow big if you have the right technology and if you have innovation. And you have multiple examples of companies which have just sprung from nowhere. The Spotifys of the world, the Salesforce of the world, the Netflix of the world, even Tesla of the world. And I think one has to be aware that we are in a very changing kind of an environment. What happened in the middle of the 20th century with industrialization and the move towards industrials, I think we are now in a phase in the 21st century where we just cannot ignore technology and innovation. So we have to be up there. And I think disruptions and trends would be the number one, I would say, factor to look at when you research any company or sector.
Well, Sunil, appreciate your time. So glad you could join us. Stay safe, and certainly hope to see much more of you going forward.
Thank you.